I want to talk to you. Hello. I want to talk to you briefly, very briefly, about why the most recent Vix spike was a typical spike and what you should look out for and what we can learn from this sort of Vix spike. Coming up right now in the Short Vol Show Live. Stay with me. All right, so we had a Vix spike last week. It started on Thursday and kind of had its peak around Friday. Let's take a quick look at the chart just to put things in perspective here. So I'm using Thinkorswim. You could use whatever charting system you feel most comfortable with. And this is a chart of VXX, the volatility ETF. And if we want to get more fancy, we could go ahead and add a study where we're actually comparing this to the actual VIX and action in the actual VIX. But it's all going to be a similar way of understanding things, whether we do that or not. But let's just do it really quickly. So we'll compare VXX to the VIX here. And you can see the spike would be the purple here, and it kind of outpaces VXX. But you can see this is, I believe, Thursday. Or no, this is Thursday here, and then into Friday. And then really over the weekend, there was a spike, and then we were kind of coming off it right now. Now, okay, so what are some of the things that make this a typical spike? Well, there was not much indication before this happened. I mean, there's a little bit of a run-up on Friday, right? But a lot of what happened overnight or over the weekend when there's not a whole lot you could do about it. And so if you were in a situation where you were short volatility, you spent an uncomfortable weekend because we had this ramp up on Friday where if you were short volatility, stuff was going against you and things didn't look good. And then you had to wait out the whole weekend until Sunday night when the futures came back up to see that, yes, indeed, things were even lower and we were in a spike. So what does this mean? This means that you have to have your ducks in a row ahead of time because spikes come out of nowhere. That's a fairly obvious point that everybody kind of agrees on. Okay, so the second thing that makes this a fairly typical spike is that it hasn't lasted very long. Now, this could continue. It's hard to tell until you have a little bit more distance from a spike exactly the whole scene. But the majority of this, as far as the VIX, only lasted like one session, and all of a sudden we're back. We're kind of falling back down again over the past few sessions. Another thing that makes this a typical spike is when we look at the options action. So, for example, I was trading these puts in VXX, and we're going to just zoom in and highlight them here. So I was looking at these January puts, and let's see if I can actually just zoom this in a little bit so you can see it very specifically here. So if we go to display, zoom, Olage, and there we go. So I was trading these puts. You can see the market right now is 47-cent bid at 48. Okay, so the nature of what happened as far as my trading was, I owned a bunch of these puts. I sold them out for 59 and 60 cents in the middle of last week. Then when the spike came and VXX was up around 15.50, I came in and I bought the puts back that I'd sold for 59 cents. I paid 45 cents for them. And you can see them here right now. The market's 47.48. So VXX has gone down almost $1, and these puts have barely moved. And the reason for that is when you have a VIX spike, they are going to crank the option prices in all of these issues. So if you come in and buy puts, they're going to perform poorly. and especially like the first part of the down move. So when we look at the VIX here, I'm just going to pull up the actual chart of the VIX now. And when we look at the Vix Spike, it's a little confusing. Let me get rid of this other stuff. And reset my chart to the proper size. When we look at the Vix Spike here, we got this big spike up to 19, and then it's faded down. Well, this first down move, you would think like, oh, it's several points down. I'm going to make a lot of money if I'm short on this first move. But what ends up typically happening is that if you try to put a trade on up in the middle of a spike here, you're going to get bad prices for it. If you're buying, especially if you're buying puts, maybe if you're selling calls, which is riskier in several ways, or if you're buying a spread, it's not going to be as true. But it can also be true on spreads just because they're not going to trade with you mid-market during a spike. They're going to try to get whatever they can out of you, and you're not going to get good prices during a crazy period. So I initiated buying some puts, but they've performed very badly on this first part of the down move off of the spike, and that's very typical. So usually what will happen is you'll get a spike, you'll buy some puts or something, and then the VIX will come in a lot, but the VXX or UVXY, the underlying ETFs, will not perform very well to the downside because what's happening is that the term structure is sorting itself out. So as the term structure sorts itself out, you're not going to make money on the downside here. It's for the same reason that people don't make as much money as they kind of hope to on the upside during the spike. Well, same reason as it goes back down the first round or two of us coming off the spike. These things are going to underperform. Your puts are going to underperform. VXX isn't going to go down as much as you had hoped for. And so that's something just to be aware of and not to be surprised about. I'm not surprised that these puts that I bought for 45 cents are only up to 47 cents, even with the VIX down a lot, because that's very typical of this trade. So, for example, we've got the VIX down 66 cents today, and VXX only down 18 cents, and my puts are performing well, maybe they're not even performing that badly compared with VXX, but you want to get used to the fact that as the term structure sorts itself out, you're not going to make a ton of money on this big VIX down move. It's going to take the continuation over the next couple of days as this settles back down to quote-unquote normal and the VIX finds a more normal range. You're going to make money, but that first down move and those first couple clicks down, maybe that first point or two down in the VIX, you're typically not going to make as much money as you'd hope for. And that's because, once again, the term structure is restretching out. It's going back into contango. As we come off of a VIX spike, the futures have to sort themselves out and get back away from the spot price again. Let me just make sure that you can see this. Okay, so this spot price, remember, was above the futures, and it's got to get back down, at least 50 cents, a point below the futures to be back to quote-unquote normal. And so what has to happen is the VIX has to move down without all these products really moving down. That's what has to happen for this situation to get back to normal and get to a situation where we can take advantage of contango again. You can see right now where we are is the futures are they're flat. We've accomplished the fact that spot is now below the futures, and it's a decent amount below futures now. It's almost a point below the futures. It's 92 cents below the futures. But it needs to go even lower before these futures actually arrange themselves in contango, and we can really take advantage of that decay coming on. Right now, the term structure is normalizing, but we don't have that decay component coming from contango. Everything's just totally flat. It's a kind of a neutral stage. So that process of us unwinding from a spike takes a little while, a couple sessions, and more importantly, it takes the VIX making a decent move back down where you're going to feel like your position is not performing the way you had hoped it to. But that's very normal. It doesn't, like I said, doesn't surprise me at all. And you can actually take advantage of that and not initiate a short until things are getting a little bit more back to normal, because you're not going to lose out that much, because these VIX products are still staying relatively high as the term structure sorts itself out. I don't want to throw too much at you today, so I'm just going to leave it there. But rest assured, this is a fairly typical spike, and the more you go through this, you don't necessarily have to put a position on during a spike, but experience it. Watch the term structure as it happens. Watch the charts. Another thing that's very typical about this spike is that as we were in the middle of this on Monday morning, I was discussing with a lot of professional traders, what should we do? Is this a time to short volatility? And, once we come off it, it seems like obviously that was a great spot to short volatility. But at the moment, there's some disagreement. We're like, I don't know, this could get worse. It always seems like it could get worse when you're at the top there. And there's disagreement among professionals about what to do there. My feeling was do something. Put some sort of short on. How big or how small, that's up to debate, but do something. But that's typical of a spike too, is that when you're at the top of a spike, there's disagreement amongst professional traders and other traders alike as to, is this a good time to short or not? There's almost never going to be a time in chat where the chat has a consensus that says now is the time to do something, except maybe if the market crashed, and then the consensus might be it's time to buy something. But beyond that, there's never going to be consensus. So you're going to have to use your own judgment and do it yourself to some extent. All right, thanks for watching. I don't want to throw too much at you. It's already been 12 minutes, which is longer than the average YouTube video. Slap that like button down below. Leave a comment. Click subscribe. Be a Patreon supporter. Check out my Twitter, and I'll see you in the next video. Thanks for watching today, folks.